Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories inside financial documents. And today we are diving deep into a financial report for Columbia Fund's Series Trust to Tho, which is basically a look at the Columbia Global Opportunities Fund, a mutual fund that is designed to invest in companies all over the world. But what is inside this detailed report? Well, buckle up because we are about to find out, and if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below, where we can chat more about these filings. So what story does this report tell us? Well, it gives us a very detailed look at how this fund performed over the last year, up to the 31st of July 2025, showing us where the money went. And where it came from, it is like looking at a company's financial health report, but for an investment fund. This filing is essentially a yearly report card for the Columbia Global Opportunities Fund, specifically looking at two main share classes, Class A and Institutional Class for the year ending the 31st of July 2025. It tells us about the fund's costs, how it performed compared to its benchmarks, and what investments it holds. Let S start by looking at the costs associated with investing in this fund for a hypothetical investment of $10,000 in class. A shares the cost was about $123, which is a little over 1% of the investment. This seems pretty standard for mutual funds. For the institutional class shares, the cost was only about $97, which is less than 1% of the investment. This means that if you invest a large amount, the institutional class is generally cheaper. Now let's talk about the performance. A big part of this report is the management's discussion of fund performance, which is basically the fund managers explaining why they think the fund performed. The way it did, they mentioned that asset allocation decisions were the primary driver of active returns for the fund, which means how they decided to spread the money across different types of investments like stocks and bonds was key. They also noted that their underlying manager selection and the use of leverage, which is borrowing money to invest, added to the results. But it is not all good news. They had some detractors in terms of performance. 2. The style effect was a drag on relative performance, which they say was primarily driven by exposure to longer-dated yields, treasury bonds, and longer-dated developed market sovereign bonds. This just means that betting on certain types of bonds hurt their returns a bit. Let's look at the actual numbers for a hypothetical $10,000 investment in class of shares over different timeframes for the past year class. A shares excluding sales charges returned 8.85%. But including sales charges, it was a much lower 2.58%. This clearly shows the impact of sales charges for the same period. The blended benchmark, which is a mix of two big stock and bond index. EAs returned 9.74%, so the fund underperformed its benchmark in the last year, especially when you consider the sales charges. This is a really important point because it shows how those upfront fees can really eat into your returns, especially over shorter periods. Looking at the key statistics, the fund has about $313 million in net assets and holds 419 different investments. The management services fees were about $2.2 million, which they say represents 0.70% of the fund. Average net assets, so the management fee is a significant part of the cost. This section shows the fund's involvement with derivatives. These are financial contracts whose value is derived from an underlying asset like stocks or currencies. The fund has quite a bit of exposure here, with significant percentages in long credit risk, equity risk, foreign exchange risk, and interest rate risk from the long side, and also some exposure on the short side. This tells us the fund actively uses these tools, which can add complexity and risk, but also potential for higher returns. Now, let's dig into the specific investments within the fund. This is the really detailed part, the actual list of what the fund owns as of the 31st of July 2025. The fund had about $318 million in investments. In securities, the biggest chunk, around 57.8%, was in common stocks, which means ownership in various companies. Globally, they held stocks in a huge range of countries from Argentina, Australia, and Austria to China, Denmark, and France. The percentage it's listed next to each country show how much of the fund's total assets are invested there. For example, they had about 3.6% in China. Looking deeper into the common stocks, we see some big names and some less familiar ones. In China, for instance, they held Alibaba Group Holding Limited and Tencent Holdings Limited in the United States, which is the largest single country investment at 31.2% of the fund. Assets, they held shares in giants like Alphabet Inc., Amazon.com, Incorporated, Apple Inc., Microsoft Corp and Nvidia Corp. This shows a strong focus on technology and large cap companies within the US market. The fund also invested in foreign government obligations totaling $31.6 million. This means they lent money to foreign governments in countries like Austria, Belgium, Canada, China, France, Germany, and Japan. These are essentially bonds issued by these countries with various coupon rates, and maturity dates this part of the portfolio adds diversive. Accession, but also carries risks associated with the creditworthiness of those governments. At the end of the day, the fund had total investments in securities valued at over $318 million. Their cost for these investments was around $275 million. The difference between cost and value is the unrealized gain or loss on these investments. This section reveals the fund's use of forward foreign currency exchange. Contracts, these are essentially bets on the future value of currencies. The fund has contracts to sell dollars and buy Japanese yen, Singapore dollars, Canadian dollars, Swiss francs, and many others. This is a way for them to manage currency risk, or even speculate on currency movements, the unrealized appreciation. And unrealized appreciation show the current gains or losses on these contracts. The fund also uses futures contracts, which are agreements to buy or sell an asset at a specific price on a future date. They have long futures contracts, which means they are betting on the price to go up for things like Japanese government bonds, Australian bonds, Canadian government bonds, and even the SP 500 index. This is how they might be trying to hedge their position or increase their exposure to certain markets. On the flip side, they also have short futures contracts where they are betting on prices to go down for things like Australian bonds, Euro Stoxx 50 index, and the FTSE 100 index. This shows a sophisticated approach to managing risk and potentially profiting from market downturns. This section reveals the fund has written call option contracts, which means they have sold the right to buy certain stocks like Camco Corp and Celestica Inc. At a specific price. This strategy is often used to generate income, but carries the risk that they might have to sell those stocks at a price below the market value if the options are exercised. This is a really interesting part of the report. The fund has entered into cleared credit default swap contracts, where they are selling protection. This means they are essentially insuring against a borrower defaulting on their debt. If a credit event happens, they could have to pay out money, the notional amounts. Here are quite large, for example, over $13 million in US dollars for the CDX North America Investment Grade Index. This is a high risk strategy potentially for higher rewards. They also use total return swap contracts, where they receive the total return on an index, like the Russell 1000 Growth Index, in exchange for paying a fixed or variable interest rate. This is another way to gain exposure to certain markets or manage risk. Looking at the statement of assets and liabilities as of the 31st of July 2025, the fund had total assets of roughly $326 million. Against that, they had total liabilities of about $12.5 million. This results in net assets of over $330 million. This balance sheet gives us a snapshot of the fund's financial position. In the statement of operations for the year ended the 31st of July 2025, the fund generated nearly $8.7 million in income. From dividends and interest, they paid out about $3.7 million in expenses, including management fees and transfer agent fees. This left them with a net investment income of nearly $5 million. The real story in this statement is the realized and unrealized gains and losses. On realized gains, they made over $27 million from selling investments, but they also had unrealized losses, meaning the value of investments they still hold went down by over $6 million. So overall, their net realized and unrealized gain was a positive $21.7 million. This means the fund made money for its investors over the period, despite some market ups and downs. The statement of changes in net assets shows how the fund's total value changed over the year. The net increase in net assets from operations was about $26.7 million, but they also distributed about $1.5 million to shareholders and had a net decrease of over $43 million from capital stock activity, which means more money was withdrawn by investors than put in. So overall, the net assets at the end of the year were just over $313 million, which is a decrease from the previous year. The financial highlights provide a summary. Per share, this is where we can see the long-term performance for Class A shares. The net asset value at the beginning of the year was $13.43, and it ended at $14.55 for the year ended the 31st of July 2025. That is a solid gain. The total return for Class A shares was 8.85%, which is quite good. The total net expense ratio was 1.18%, which is the cost for the investor, and the portfolio turnover was 100%, meaning they effectively bought and sold all their holdings in the year for institutional class shares. The net asset value started at $13.62 and ended at $14.76. A similar and healthy increase, their total return was 9.12%. Also very strong, the expense ratio for institutional shares was lower, at 0.93%, showing that larger investors generally get better pricing. These notes are where the really detailed explanations are. They cover everything from how securities are valued to how the fund accounts for foreign currency transactions and derivatives. And they mention the fund is registered under the Investment Company Act of 1940, which is a key piece of legislation for regulating mutual funds. The security valuation note is crucial. It explains how they determine the price of each investment when market prices aren't readily available. They use pricing services, broker quotes, and even their own internal models. This is important because accurate valuation is key to ensuring fair trading for all shareholders. This section goes into detail about their use of derivatives. The fund uses forwards, futures options, and swaps to manage risk and potentially increase returns. The notes warn about the potential for substantial losses with derivatives and highlight risks like counterparty credit risk and leverage risk. This is where the fund managers are explaining the potential downsides of their investment strategies. This table shows the fund's exposure to counterparty risk. Basically, it is illustrating how much money they could realistically lose if the other party in a derivative contract fails to pay. This is a look at how they manage risk when dealing with complex financial instruments. The federal tax information shows how the fund's income and gains are taxed for shareholders. They are designating a good portion of their income as qualified dividend income, which is taxed at lower rates. This is usually good news for investors. This section details how the Board of Trustees approved the renewal of the management agreement with Columbia Management Investment Advisors, LLC. They reviewed investment performance fees, nature of services, and profitability of the investment manager. The board concluded that the fees were fair and reasonable, and that the services provided supported the continuation of the agree. Meant they also considered economies of scale and profitability, which is a standard part of this review process. So what is my take on this report? Well, this fund, Columbia Global Opportunities Fund, is actively managed and uses a wide array of tools, including derivatives and investments in foreign markets. And emerging economies, the financial results for the year ending July 2025 show. Health. Growth in net asset value for both Class A and institutional shares, especially considering the market conditions. The strong performance in total returns for both classes is impressive. However, the report clearly highlights several risks, including the inherent risks of derivatives, foreign securities, and leverage the fact that the fund underperformed its blended benchmark in the last year, especially for Class A shares after Sol. Charges is something to pay close attention to. The higher expense ratio for Class A shares compared to institutional class is also a notable point for individual investors to consider the fund. S strategy appears to be quite aggressive, aiming for growth through global diversification and active management, including significant use of derivatives and exposure to emerging market. This approach can lead to higher returns, but also comes with higher risk. The details on derivative usage, particularly the credit default swap contracts where the fund is selling protection, are particularly noteworthy, as this is a high-risk, high-reward strategy. Overall, the fund seems to be run by experienced managers who are transparent about the risks and rewards associated with their strategies. Renewal of the management agreement suggests the board is confident in their ability to navigate these complexities, and for investors, the choice between Class A and institutional shares, along with their respective expense ratios, is a key consideration for maximizing returns. What is your take on this fund? S strategy and its performance. What do you think of the risks involved? Let me know in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.